Good morning, everyone. Welcome to the August meeting of the Yankee Model Investment Club. My name is Brent. I'm the president. And for the next few minutes, I'll be walking through a few introductory slides in case this is your first time joining us. And after that, we'll get started with our normal club operations. So the Yankee Model Investment Club is a better investing, or BI, model club. We are fully functional with real money, but we're open to observation by the public. We're formed back in 2008. We're currently 6 members spread across 4 different states. We went online in 2011, and we meet the second Saturday of each month at 11 a.m. Eastern. We're always looking for new members. No investment experience is required. If you're joining us as a new member, you'll be mentored by an existing member, and really no limitation of where you live, except where your state tax laws require the club to file a return. All of the partners of our club must be members of Better Investing. You're expected to actively participate in the club's activities. This isn't a passive investment vehicle. And make stock presentations using the stock selection guide and our analysis template in rotation with other members. For club operations, we follow better investing principles. We show respect to fellow club members. We have to remember we're all still learning this, regardless of how much time you spend in learning about investment. We perform an annual audit of finances. We file our tax returns and follow our partnership agreements. And if you have any questions on either the operation of the club, or if you're interested in joining us, you can reach out to our secretary, Sriram, at the email address shown on the screen. I'll also put his contact information back up at the end of the meeting in case any questions or comments are generated through the course of the discussion. For the structure of the meeting, we follow a standard agenda, which is available in the handout section, as well as there's a few other files that can be downloaded from that section for your own benefit. All visitors will be muted throughout the meeting, but you can type in your questions using the GoToMeeting control panel. Joe is our moderator, and he'll be responding to those questions throughout the meeting, and usually chimes in if there's a general interest topic that would be a benefit to the larger audience. And then we can have a short Q&A session at the end of the meeting if there's any open questions. So just a note on registering for this meeting series. Like I mentioned, we meet monthly. And if you were forwarded the invite from a friend, that means that the Better Investing and the GoToMeeting system doesn't have your contact information. So if you like what you hear and want to be notified of future meetings, we recommend you register for this series by going to betterinvesting.org and looking in the local events, online local events section. And this just has the benefit of you getting an automated email a week, a day, and an hour ahead of the meeting with the login information. And then finally, a disclaimer, as I'm sure you're aware, we will be discussing financial topics in this meeting. This is in no way, shape, or form to be taken as recommendations for how to use your own money. No recommendations for purchases or sales are intended. Do your own research before investing your money in anything. And then with that, we will jump into our regular agenda. I will kick it over to Ira for educational segment for visual analysis.
Okay, do you see my screen? Nope.
Not quite yet.
Now do you see my?
Yes.
Okay. I thought I'd start with the, this is the classic life cycle of a successful company that Better Investing has shown before. Starting with the speculation area, this is where you find your startups. If you want to invest in speculation, Better Investing never says don't invest in speculation. They just say limited to like maybe 10% or whatever money you feel you might want to lose. And this is where you would find your meme stocks, your Robinhood IPO, your GameStop, your specs, all of that type of stuff. Be my guest. If you might double your money in a week, who knows? If you want to put all your money in the Reddit crowd, the YOLO investing, they call it, which for those of you who don't know, that means you only live once. And be my guest. But better investing focuses on this green area. We're looking for growth companies as the best investment opportunity. That doesn't mean you can't invest in the stabilization area. If you're retired, if you are looking for dividends, if you want solid companies, please invest in this area. You might want to invest in utilities, might want to invest in stocks like Pepsi, real estate investment trusts. Your dividend aristocrats would all fall into this area. So feel free. You don't have to do what better investing concentrates on all the time. So, but the stock selection guide has these sections, and I'm going to talk somewhat about visual analysis, which is the graph that you see when you open up the stock selection guide. Then we have evaluating management, the history, risk and reward, 5-year potential. These are all great topics, and there's lots of training you could find on the website on all of these. So the BI objective using the SSG is to find consistent growth and then determine a reasonable price for that growth. So we're looking for growth at a reasonable price. So looking at the first part, the graph, we use it to judge management quality, and it's an indicator of future potential. They say, past growth is no guarantee of future growth, which is true. However, it's all we got. And we look at the past history for the potential of future growth in a consistent manner. Okay, so this is the what the graph looks like. For you nerds out there, this is what we used to call semi-log graph paper, which means the y-axis is logarithmic, cycles of 10, if you want to call it that way, whereas the x-axis is in years and it's linear. So why do we have a graph like this? Well, it's because the straight line slope is an indication of growth rate. The greater the slope, the greater the growth rate. So the top line is sales, the middle line is pre-tax profit, and the bottom line is earnings per share. If you take the sales line and you subtract out expenses, you have pre-tax profit. If you take the pre-tax profit line and you subtract out taxes and the number and divide by the number of shares, you end up with earnings per share. Okay. So you can learn a lot just by looking at this graph. For example, the pre-tax profit rising faster than sales. That's great. And you could just visually look at it and you could see that back here in whatever year this was, the gap is large, and here the gap is decreasing. Now here's an example of sales are steady, but pre-tax profit and earnings per share is falling off. And that's quite obvious just by looking at it. So you need to understand what is going on. Are they doing acquisitions, or what's the story? You need to do your own research and figure it out. But just a quick look will tell you that this is what's happening. And here you have the opposite. Pre-tax profit is rising faster than earnings per share. More shares now, either more shares are being issued or the taxes have changed. The taxes have gone up. That's why the gap between pre-tax profit and earnings per share is widening. You can see the sales are staying steady. And here's an example where you see sales are steady, but the profit is erratic. So what is going on? Obviously, their earnings is more cyclical. Find out why it's looking that way. Here's an example. Maybe you don't want to own this company. Pre-tax profit growing about this. This is what we classically call railroad tracks. Or if you live in New York, it's subway tracks because it has a third rail here. So, a little How to Invest by Will Rogers. Doesn't go up, don't buy it. Now I want to show you some real world examples here. And we'll close out the PowerPoint. All right, now other club members could chime in here. What's going on here in this graph? This is Monster Beverage. Anybody?
Earnings are growing faster than pre-tax profit.
Maybe stock buyback or something.
Now why? There's an easy way to find out what's going on here. You see the gap between pre-tax profit and earnings per share is narrowing. Okay, yep. That's great. All right, now a quick way to find out why. You click on the preferred procedure. You go to taxes. Look what happened between 2019, 21.8%, and 2020. Taxes fell to 13.3%. Now, is it going to stay that way? Absolutely not. Just look at 2021 Q1. Quarterly taxes, 23.8%. So this was just a one-time thing. Look at earnings, look at diluted shares. You can see the diluted shares didn't change very much. So the whole effect of what's going on in that graph there is due to this tax change. So that's a quick, easy way to know, why did that happen?
Yeah.
Now let's look at another case here. Look at Visa. Okay, so what's going on here? Look especially at the quarterly numbers here, which are these circles right here. Okay, well, nobody?
Yeah.
All right. Well, let me show you. Once again, in the preferred procedure, look at taxes. 2020, 21.2%. Look at the third quarter, 41.3%. This is not going to hold. This was an anomaly in the third quarter, but that's what affected the earnings per share. So very quickly, you could see what's going on here. Look at Nexstar. So here you see steady sales, but the profits are erratic. Nexstar is somewhat cyclical in their business. That doesn't mean it's a bad buy. Might be a good buy. It's just something you have to understand when you're looking at the company. Okay, so here we have one of our holdings, UFPI. Look at the gap here. Look at the gap here.
Yeah.
You can see that sales are growing faster than expenses. Pre-tax profit is rising nicely. So you don't have to be a numbers person, you just have to be a visual person, and you could get a hell of a lot of information here. Okay, here's another one of our holdings, Intelligent Systems. This one's a little harder to interpret. You can see that like everything is all over the place. Sales, pre-tax profit, earnings. Once again, it doesn't mean it's a terrible company. It's just understand what's happening here. And that's my presentation.
There are no questions posted.
The mark of an excellent presentation.
I
All
have,
right, thanks,
I have a
Ira.
question. Hi,
Yeah,
this
go
is
ahead.
the question.
Yes, Liz?
So I hear in the news about these companies that pay zero in taxes. And then I look at the SSGs and these companies are paying taxes. And I'm just wondering, how does a company get to zero? And is there a way that a company that was paying like 20% or something reduce that?
How long is the tax code? 1,500 pages or 25,000 pages? It's hidden in there someplace, Liz. Special structures that are available to lots of different taxpayers to reduce the amount of taxes that they have to pay. That's a whole 2 courses.
Yeah.
One of the main things that happens to get to zero is that you lose a lot of money one year and then you use that as a tax loss the next year.
Right.
So you're basically making money for free because you didn't make any money last year.
Okay.
You lost money last year.
So I guess my question is, I shouldn't be thinking about, well, is management doing a good job because they're paying 20% or more in taxes? Or is that something to consider about management? Is it a reflection on management?
I think that's a good question, but I think it's more complicated than that. You want to see consistency, but the tax code changes so wildly from one year to the next, from one administration to the next. It's hard to make things consistent.
Right.
Yeah, I would say that the better play is probably like Ira showed, look at the kind of historical trend of the tax rate and just make sure you're not overly punishing the stock analysis with too high a tax rate or, giving you a false sense of security with too low of a tax rate. But as far as reflection on the management team, I don't know. You hope that the management team, whatever they're supposed to be paying in taxes, the company pays them in taxes, and you just account for that in your analysis.
Okay, thanks.
And I think just to reinforce kind of Ira's the presentation, or the nice benefit of the visual analysis is that it's with these tools, obviously it makes it much easier versus the days of yore with, paper plotting of the yearly revenues and earnings per share and everything. But this is it's put right at the beginning of the SSG, because you can very quickly sift through many companies, and just from the visual look of the chart, know that this is a candidate for further study. I don't think you'll ever see one that you know immediately that you're going to buy it. But on the flip side, there are several companies that I've seen in visual analysis I definitely did not want to buy it. I ran screaming away from them. I think Ira had one slide as an example with a flat green line, and you can hardly even see the pink and blue lines just because they're down below the zero axis of the chart. But it's just it's a great method to sift through many companies without wasting any time on looking at other fundamentals. You can look at the charts and know, okay, this is a candidate I want to spend more time with, versus I'm not going to waste another second looking at it.
And it's not just looking for up, straight, and parallel, which they keep talking about, but look at the trend. Look at what's converging.
Yeah.
Look at what's erratic, whatever.
Okay, any other comments by the team members? No? Okay. Great presentation. Thank you very much, Ira. We will move on then to the club secretary report. I'll take presenter rights back. And in Sriram's absence, I'll zip through the minutes that he put together. So these are the minutes from last month's meeting. Liz presented on executing your orders. We accepted the minutes from the previous meeting. Jack presented the treasurer's report. We put our holdings and the diversification chart as usual. Jack presented SSG analysis for Algonquin. Let's see. We decided to buy a superior group of companies with available funds. We had a discussion on cross-training. PERT judgments were refreshed. Then some questions from visitors. I didn't quite follow all of these, but they're there for the record. And then we adjourned. Any comments, questions on the minutes? Okay. Then next we'll go to treasurer's report. I'll get over to you, Jack.
Okay. Let's see. Let me get to the valuation. All right. So this is the valuation statement for this month. Sorry, this is last month's. This month's. We're over $240,000 in net assets, so that's a record. Yay! I'd like to point out that, again, in a fairly unusual circumstance, we have only one loser in our portfolio. It's for a group of companies. It's basically broken even. Okay. Member status. All members are up to date. We're basically the new guys, including me, and the old guard, each of them about 30%. transaction history, we got our penny dividend from our cash. We purchased another 61 shares of Superior Group of companies. And we brought the average price per share down a little bit. I'm not sure we got any. Yeah, we did get one dividend this past month from Dollar General. And then here's the member payments. We were, as I said, we're up to date. Okay, where's this thing? There we go. Performance benchmark. Let's see. So from inception of the club in 2008, we're up 16% compared to the Vanguard 500, up 15.8. We'd like to beat the benchmark by more than 0.2%, but that's where we are. If we go to 5 years ago or so, we're up 17.5%, which is actually 0.5% worse than the Vanguard 500. So that's not good. If we go to just this year, start from the beginning, we'll do year to date more or less. Let's make that a 1. Okay, we're doing better by 5% than the Vanguard 500 index. Let's look at a different, say, mid-cap fund or something. Doing 8% better than that. There's a whole market fund down here somewhere. Total stock markets fund. %8 better. So yay us. Okay. How are our individual investments doing? So DR Horton's beating the bunch at almost doubling since we bought it in January. Middleby's doing good. Tractor Supply. Sprouts is doing good. In general. Let's look at the other end. The Essent is down a touch. Intelligent Systems Group is also kind of below average. We'd like them all to be growing at 15% or more per year. The ones we more recently purchased, they usually don't tell us because the numbers aren't meaningful. So this is I'm not sure what that's saying. Oh, 56%, there we go. So it's not really, it's just not enough time has passed yet. Superior Group probably is negative a little bit, so that's, again, doesn't mean much. Okay. Member for performance. This mostly has to do with when we put our money in. So the old guard is doing about 16%, and the new people are doing better. And Liz takes the cake. She wins this month's lottery. Okay. And that's it. Go go back to the valuation. Do that again later. So that's the treasurer's report.
Okay, thank you, Jack. If there's no other comments, then we'll move to my stock presentation. Okay. So today I'll be discussing Investors Title Company, ticker ITIC on the NASDAQ exchange. And I found this company through one of the posted Better Investing, I guess, screens that is linked from their weekly email. They have a whole bunch of different, like, value and growth, value and dividend, all the different, like, kind of combinations or types of screens. I unfortunately couldn't tell you which one exactly it was. I think it was maybe small cap, small growth cap or something. But sifted through the 10 or 20 companies on that list and happened upon this one that looked pretty promising. One of them being, and I'll take it from Ivor's presentation, it's not completely straight, but it does have a promising upward angle of lines, and the three lines more or less track with each other. So this passed my initial criteria for a visual analysis for me to proceed with more behind the scenes looking at the company itself. For capitalization, market cap 364 million, which puts it in the small cap range. Sales of about 282 million. Industry is financial insurance, specialty. And what it is, they issue residential and commercial title insurance through two subsidiaries. And just to jump down here for people that don't know what is title insurance, and because I needed to refresh my memory as well, it protects the mortgage lenders and the homeowners against claims questioning the legal ownership of a home or property, which is the title, hence the name of the company. If the disputes over title ownership arise after the purchase, the insurance policy pays for the legal fees to resolve them, this is kind of the opposite direction of insurance compared to, car insurance or health insurance or something where you're protecting against a future event. This title insurance protects against past issues that could be uncovered during or after the purchasing process. So in any real estate transaction, the title company runs a public record search to ensure that the home being purchased is free of clear of any liens or ownership disputes. And the title insurance then covers that any underlying issues that the title company may have missed are covered, at any potential point in the future. Let's see. So really, this is useful on whenever there's a sale of a property, residential or commercial. Don't think there's anything else here. Okay. So it issues title insurance policies primarily through approved attorneys and underwriting offices, as well as issuing agents 21 states and the District of Columbia, primarily in the eastern half of the United States, headquartered in North Carolina. So proceeding through, I couldn't find that there was really any debt to speak of. Unfortunately, this isn't fully analyzed by Value Line or Morningstar, but as far as I could tell, for all intents and purposes, the debt level is kind of nil. I looked on ChartMill for Altman Z, and they hadn't analyzed it, but I think the financial numbers give an indication that they're not at risk of bankruptcy anytime soon. I call this a growth company. Looking at historical revenue growth from 2014 to the present, and that's just because I tend to discount older years just because the management team might have changed and it was a different time back then. 10.6% earnings per share growth, 26.1 over the same period. And I'll go through the SSG here in a moment. For analyst info, like I mentioned, this isn't really followed by any of the major analyst groups, Morningstar, Value Line, but they did have some cursory information. Morningstar puts the fair value at $207 per share and puts it at 3-star rating. For Value Line, they just put a performance values 2, 3, and 3 for performance, safety, and technical. Through TD Ameritrade, they offer a few different research reports, which is interesting to kind of take with a grain of salt, but because I don't know all the hidden analysts' approach, behind the scenes, or the financial maneuverings that they do to make something a strong buy or strong sell recommendation. But for all intents and purposes, that cross-section of reports all point to this being a strong buy. So for the CFRA, it was strong buy, moderate risk evaluation. Forward Equity Research, a rating of 1, very positive earnings strength, very positive relative valuation, and price movement and neutral. And I guess it might be worthwhile to just jump through some of these. CFRA report, so things are looking promising. I won't go through the details of all of this. The street quant ratings, take this as you will. Forward Equity Research looks promising. Strong valuations there. Yes, so then the projected growth I used for my analysis, I put it at 10% based on that historical growth from 2014 to the present, and then pegged the earnings per share growth at that same value. So even though there's some indication that this earnings per share is growing a little bit faster than revenue, I'm kind of stuck in my ways. It's like an old rule of thumb from early on in better investing, where there's at some point you can't grow earnings past the gross revenue that you bring in the door. So I tend to match these two values to each other. Then looking at management, pre-tax profit margin 21% is up from the 5-year average of 19.8. The 5-year range, just for reference, is between 18.7 and 21%. Earnings on equity is 18.5% up from 5-year average of 14.6, and the 5-year range is 11.1 to 18.5. For the PE history, this is on the cheaper side of the stock, I think. Average high 14, average low 8. It's approximately 11.4 currently, or I'm sorry, average is 11.4, and current is 5.9. So running through the calculations, I put the high price at 614, low price of 270, and then buy range up to 225 compared to the current price of 187. So upside downside 5.2 to 1. Oops, I think this was left over from previously. Sorry about that. Relative value 49%, peg of 0.51. 5-year potential current yield. So they do pay a dividend, about 1% on yield, and then compound annual is 28.7, and then projected average is 24.9. So then going through some risk and rewards, the biggest one is what would impact property sales in the future. The main thing I could see is unknown with future COVID spikes. I think if this was a year ago, we'd be in much more dire straits. But now that we have reinstituting of mask mandates and vaccine rollout and things like that, I think this is going to have a much lower impact than in the year prior. But still, it could have unforeseen consequences on people's jobs, and therefore the need or the desire for people to sell their homes and other property. On the reward side, It's a small cap company, which we've always struggled to find. I feel they have a strong growth record from historical and where they stand currently. Pretty healthy profit margin. Like I said, both of these two values are slightly up from their historical levels. Relatively low share price, so I think it's a pretty good buying opportunity. And I believe insurance has usually been a cash cow, at least from hearing discussions from Warren Buffett and his insurance holdings, that usually, I mean, people pay premiums and everything, and hopefully without major disasters, that is money that you can pocket. And then I included just an excerpt from Realtor.com a couple of days ago, where the inventory of active listings declines by 33%. So this is, I believe, open home or homes that are on the market. That inventory level decreased 33% over last year. Newly listed homes on the market are up 6.5% nationally compared to the year prior. And typical home spent 38 days on the market in July compared to 60 days in the same month in 2020. Just for reference, this is the Realtor.com article that I pulled it from. They have some charts here just to show how it's interesting that the housing market is fairly cyclical. 2021 is way down here in the yellow, but where it's lower than 2020, but it's more similar to the trends shape, at least, of years prior. So who knows how it will extend past this point, but it is falling, at least the shape, back into before COVID times. Newly listed homes, they tend to be, have a general shape as well. So we're kind of at the crest here, and not sure what the future holds, but it looks like it's returning to, normal shape. Okay, so yeah, taking all that into account, I think it's worth the risk, considering with the unknown from COVID, that this is a buying opportunity. We can go through the SSG real quick. Showed this previously before, but I discounted years before 2014, which gives a historical revenue growth of around 10.6%. So I just took that to be the forecast for sales and earnings per share.
Frank, could you add free cash flow to that? Just wanted to show what that looked like.
Yeah. So I think it took a hit in 20, definitely, because they overall had a, problematic year with COVID. I couldn't explain, or I didn't look into this drop in 19 as far as what that's from. But it looks like it's back to at least 19 values here. Scrolling through the other ones, this looks fair. Dividend, total debt. So this was strange that there is a value on this chart, but I don't know if this is just such a low, I don't know what the units are for the debt, if that's millions or thousands or what, but it shows up on the chart. Net income. So it's pretty flat shares outstanding also. Looking on the page 2 of the SSG, price to earnings ratio, pretty reasonable, I think. We went over these numbers already, and then going through the calculations. Yeah, have it in a buy zone. I guess I refreshed the price as of yesterday, so I think I had 5.2 to 1. It's actually 4.7 to 1, but still positive. And yeah, with a dividend, sweetens the pot a little bit, but overall, I think it's has promising price appreciation potential for this.
Could you do one more thing? Do you
Sure.
have a stock comparison for Essent? Because they're in a similar market and business. So I did the comparison, and Essent seems to have come up better on my comparison. I wonder what you have.
I probably need to pull in a SSG for Essence. I don't think I have that. I just recently changed to the online SSG, so I don't have any of my old studies. Do you have it up, or do you want to just tell us the highlights?
Yeah, we could switch to my screen here.
Sure.
Want to do that? Now, I'm not following Essence, just as a disclaimer here. I'm not the person assigned to that. However, this is what I had as a comparison. So Essent, which is, like I said, it's a mortgage business, which is a little different, but similar market, I would say, and worth comparing. So I thought that Essent, which we already own, was a better company to look at. Although I have a buy on yours. I have a buy up to 198. So
Okay, yeah, I guess I must admit I don't know, or have forgotten the details of what Essence does. They're like a
Essent
mortgage
does
broker?
mortgage insurance. They do mortgage insurance.
title insurance, it's mortgage insurance.
Oh, okay.
But
Gotcha.
same market basically.
Sure.
But it's a different risk structure.
Yeah.
As in, like, fearing mortgage insurance would be that if people like default on the mortgage itself, you mean?
Well,
Yes.
Exactly.
exactly. But there's more detail if we need to talk about it.
Okay. Okay. Well, this is good insight. So, yeah, potentially from this, it would be, would we want to, if put more money into the same field, possibly put it into Essent as instead of a separate company or another holding?
Yeah, that's basically my comments on this.
Sure.
I had a similar question, just expanding it out a little bit, because we already have Horton, which is in the housing industry, and we have FSFG, which is banking, which could be tied to housing. So I'm just wondering if we're too tied into the housing market as an industry, whether that's something to consider.
Again, the risk profile is different.
Yeah. I was worried the same thing, that we didn't want to concentrate on home sales, and this would be our third company in that. So I was thinking of exactly along the same lines as Ira, as which would we rather have, Essent or ITIC? And Essent kind of screwed us over last year by kind of throwing into the pot a bunch of debts. They wrote off a bunch of stuff last year. So their comparison looks spectacular this year, but it's from a very low number. And they haven't actually grown that much over the last couple of years.
Well, that's what I was wondering, that on the screen here, I'm not familiar enough with stock comparison guide, but did you refresh your Essent analysis just recently, Ira?
I did. Yeah, so it's
did,
relatively up to date.
Oh, so this is your analysis, Jack, that Ira pulled in?
No, my analysis looks exactly the same as Ira's.
Oh, okay.
Yeah, both of these are from my own stock selection guide studies.
Yeah.
And they are refreshed.
Okay. What was
But mine looks
showing
very
was up
similar.
up at the top at you know, the 2018 date, but I guess that's just the name of the study, not the actual data. Okay.
Yeah, that's when I first did a study.
Okay. Okay. Any other comments, questions? Sweet.
So,
Okay.
yeah, I got a
Oh, go ahead.
question. So comparing Essent to this title insurance, is this IT, what is it? Sorry.
ITIC.
ITIC does this have better potential growth than Essent shows?
I think in terms of the market, it's exactly the same. They're just insuring slightly different things about home sales. Everybody needs title insurance, but not everybody needs mortgage insurance.
Mm-hmm.
Only people that can't put down more than whatever the percent is, 20% or something. So that is slightly different, and as Joe was saying, the risks are different. But basically, if nobody buys anything, neither one of these companies make money. So they're both dependent upon home sales.
So if you were going to compare them, the estimated earnings per share of Essence is at 12.8 and ITC is at 8.7. But the compound annual return for ITC is at 18.3 versus 16.2. So yeah, it looks like they're kind of, I don't know, like I'm thinking like, would it make sense to dump Essent and go to ITC, but I'm not quite sure.
Well, the one
Those
thing
numbers look essentially the same to me. 11.3 and 10.9. I mean, that's
Right.
the average.
the thing that's different and stands out is that ITIC has a very low PE ratio. It's 5.4. Essent has got a low PE ratio, but it's almost twice as high at 11 point. It's over twice as high at 11.2. So that's the difference. And
John, that's a good comparison. What I look at is the difference between the current PE and the average PE for both companies. And ITIC is at 5 versus 11, and Essent is at 11 versus 10. I also look at relative value, which is another way of looking at the same thing. And I look at the PEG ratio also, and they're both nice.
yeah. Yeah, the relative value is 47%, and the PEG ratio is 0.6.
Mm-hmm.
And PEGI would be even better than that, I guess.
Yeah, because the ITIC has a slightly higher yield, so yeah, it would be a little bit better.
Yeah. So I think it's to me, I think it might be worth exchanging Essent for ITIC because it's a better buy. It's a cheaper stock, even though it's growing more slowly.
Is Essent the one that we're basically back to zero?
We're basically break even now, I think. Let me look again. It had been down for a long time.
Yeah, and I wonder if these growth numbers from Essent that are on the screen, is that because we're now back to like at the 0 point, and so it's now projecting what we thought was going to happen whenever we purchased it years ago.
Right. So we bought it at essentially the price we've got now. We're $17, $18 below water.
Does it say when did we start? When did we first purchase it?
I'd have to look. I think I can find out. Just a second.
Okay.
So we bought it. We
ahead.
bought it in 2018. Yeah,
Okay.
and we've bought it several times since.
Okay. As on a side note, just from, you know, when we do the treasurer's report and you go through our historical performance compared to the, you know, just a straight index fund, like the question, and I think I might have brought it up at previous meetings, how do we obviously would like to surpass the index fund performance, and how do we do that from like a metrics standpoint? You know, how do we kind of trim the losers and invest more heavily into the winners, that sort of thing? And I wonder, I know we have PERT as a tool that kind of tells, here's some historical information and the projected growth. I don't know that there's a tool, even like individual, like IAM or something. Ideally, there'd be a tool where we set, you know, we draw a line in the sand saying, okay, it's August 2021. We're going to buy 100 shares of Essent. We think it's going to grow 15% per year. So in August 2022, the share price should be, you know, whatever that is. And then we do kind of a reconciliation of, okay, we projected 15%. It only grew at 3%. Therefore, we should, you know, cut our losses or adjust how we predict growth rates. You know, and I know that we refresh the analysis and everything, but I don't know that there's a good chart that shows like historical what our judgments were and then what the actual reality was when that future point in time came to be. So if anyone has that, I'd be open to it. Other than, you know, we could plot it in Excel, just export the information and have a running total. But you know, lazy me wants something more automated than that. But throw it out there in case other people had the same concerns, or if I'm missing something obvious, you know, to kind of review that performance and how to steer the ship a little bit different to get even better returns.
One thing, Brent, the person presenting is supposed to save their info in our Vivio, so we could look at their original analysis and compare to that, see where we're at.
Yeah, agreed. And we can certainly extract, and maybe that's going forward, maybe that's what we do, like in addition to save the SSG, if we decide to buy it, and it might also be, you know, interesting exercise just for things that we decide not to buy, we look back on, oh, we probably should have bought it, you know. But I think in addition to the, you know, saving that SSG file, ideally we'd extract some key information to a running chart or something. But it was basically that, but is there some feature in PERT or online SSG or something where you can draw a line in the sand and compare your future self to your present self, as far as how your judgments were? But I'll noodle on that and see if maybe we, from the SSGs that are in there, I make note into an Excel file and we kind of review at some future date.
Hey, Brent.
Yeah.
Joe, send me a copy of your purchase list of the stocks, your cost basis. There's a separate report out there in Vivio that you can send me each of the tax lots. It's just send it as a PDF file. I do something in one of my clubs that I will do for you guys and show it to you next month offline, so that you can decide whether it's something you would be interested in or not.
Sounds good.
If you look in Vivio, you'll see that there's a separate report that kicks out for tax lots.
Okay.
Jack, you can take
In
that.
essence, I need number of shares, date purchased, and purchase price is what I'm looking for.
Yeah, I got it.
Okay,
Great. Thanks, Joe.
sure.
Yeah, Essent actually we sold and harvested a tax loss for in December, so we just have one purchase lot for that.
Okay.
So it's the simplest of the ones I see before me now. The tax lot. I can send it to you.
Okay, thank you.
Okay, Steve, I'll pause and give you space if you wanted to give your commentary,
Yeah.
or otherwise we can move on. Okay.
Yeah, I sure do. So in my analysis notes, I did have Essent versus this company, but it's kind of bubbled to the top. So I'm going to tackle it first and then go back to my regular analysis notes. So here's how I see it. Essent is private mortgage insurance. And Jack, please forgive me, but what you said was wrong. So
Sorry.
you don't have to buy title insurance. You have to buy private mortgage insurance if you don't meet certain metrics. What do I mean by that? And here's a case in point. Happens to be a relation of mine. I'm just giving this as an example. 3 siblings, parents died, they split the house. Let's use a round number of, say, 300. Their house is worth 300,000. 2 siblings get 100,000 apiece, and 1 sibling lives in it. Well, of course, the sibling has 33% equity. They don't have to buy private mortgage insurance. Oh, whoops, they do. Why? Because their credit sucks. So private mortgage insurance is a requirement where, at least I Googled Connecticut and Mass, the title insurance is not, right? It's a nice to have. It's a warm and fuzzy feeling for the owner. The other point with that is that, right, these are very interest rate sensitive stocks that no one's brought up. So in my opinion, the big hammer is not the Delta variant. The big hammer coming is interest rates. So, and who's going to survive the interest rate better? Investors Title Company or Essent? So as interest rates rise, less and less people will be able to buy mortgages. More and more people will have to buy private mortgage insurance in order to buy a home. They won't have that with the title insurance. The title insurance is pure volume, whereas the Essent, the private mortgage insurance, there's more factors involved. As the interest rates rise, less people will qualify. Oh, I have to get PMI now, and to be able to purchase the house. That will increase. So I think that's what we've seen. Looking back at it, you expected at this huge volume of house buying that Essent would shine. Well, no, because it's not forcing as many people to buy the private mortgage insurance unless you have really crappy credit. So that's kind of my take on it this way, and then I'll run into my normal analysis of this. So for the pros, Brett, I'm sorry, I don't see the Delta variant as the big blocker here, and if anything, from what last year's shown, it's going to help it. If history is any indicator of future results, is going to be good for it, because why? People are going to work from home. They want to buy more space, more bigger homes. The other thing that I really liked about this stock was that, at least from what I saw, it wasn't just a small cap, but a micro cap stock. So it's very, very small. And as Brent said, my SSG had 3.5 million of debt, virtually nil, exactly as Brent said. The PE is super low. And this company compares very, very well against Old Republic, which is really one of its main competitors. I had this thing in the buy range. I picked the lowest. Let me fix this. The recent severe market low price of 96.50, all the way to $236.80, and we're at 187. So it's way in the buy range. So I thought that was really good. It's got a lot going for it. So here are some cons. Looking at kind of the flip side of it now. So you don't have to buy this insurance, at least not in Connecticut and Mass. Essence Insurance, yeah, you have to buy it. So how are we on a value perspective here? Not too good. We're buying at the absolute peak. Why? Because they had a blowout quarter this month. So we're not timing it very well. Also, this is a highly interest rate sensitive stock, as is D.R. Horton, as is Essent. So as interest rates rise, D.R. Horton and this company, in my opinion, would have to be looked at very carefully to jettison once interest rates start to roll, because we know that there's inflation. It's coming. We certainly don't see any evidence of it at the bank, but it's bubbling. It's behind the scenes, and it's going to come. So yeah. So once I think the Fed starts moving interest rates up, this stock is actually going to hit its market low. Not right away, of course, but once they start ratcheting the rates, that's going to squeeze the amount of potential buyers in the market. One con, I didn't know if this was a con or a plus, but I put it down in the con section, is that it's family run. It's started by the founder, and he's got his 2 kids working there, and I don't know how happy that was. The other thing was, I was reading the 10Q on this thing, and they don't seem to write in a lot of states. I saw North Carolina, South Carolina, Georgia, and Texas. That's their bulk. And then they had all other states. So I thought that was interesting. So they didn't seem to have a large demo. They certainly have the market in those states, but and why? Because their commission that they give their salesmen is ginormous. It's like 68% of the premium. So yeah, I'd want to sell that insurance if I was going to get 68% of the premium. Yeah, I'd try to sell as much as humanly possible. And of course, how could I forget? They actually had a negative quarter. And that was last year. Minus $3.71 a share last year. Not pleased. And it was quite evident that it was just, okay, the pandemic hit. What do we need to write down? Okay, next quarter, boom. And then they went negative. So they're not beyond doing that. So that's kind of where it was with that. So my opinion is this, that I think this is fine. Why? Because Fed is putting gas to the economy, but the second that they start raising the interest rates, we have to look very closely at jettisoning this and Horton, because they're going to come under pressure. But it looks, certainly we needed in that 25%, 50, 25% for our goal. I think this is a wonderful thing, and it certainly has a low PE, but yet that's one thing I had a hard time with. The PE is so low, but the stock price was at almost an all-time high. So that's kind of my take on it. Yeah.
Okay, thank you. That was pretty exhaustive. I appreciate it. Just on the point of private mortgage insurance versus being required versus title insurance, I agree that I think PMI is required if you don't meet certain criteria, written in the law that way. I can understand that title insurance is not written in the law, but isn't it effectively, if you're going through like a major bank for a mortgage, don't they generally require it, even though it's not in the law that way, just to protect their own, I guess, protect their own assets or them from, any problems down the road?
That is correct.
Well, I've only, okay.
I worked as a bank examiner for 10 years. I worked in 11 or 12 states, and I never looked at a loan that did not have title insurance on it.
Yeah. Okay.
The bank wants the protection. If the attorney that does the title work makes a mistake, the bank's mortgage is then at risk. They want to reduce that risk, so banks require title insurance if there is a loan involved.
But you bring up a good point, Steve, that I do not know that there's some percentage of total transactions that require PMI. Maybe a vast majority of transactions do require or do have title insurance, but I don't know if you take like transactions that have title insurance times the amount of revenue generated compared to the fraction that have PMI, but maybe they have a much larger, payment or revenue generated from that. I don't know what that comparison would be. But
Right,
your other arguments are sound and yeah, good information to have.
No, and also I think there's like two kinds of title insurance, one for the bank and then one for the person as well.
That is correct.
So yeah, so then I think the one for the person, because I remember always being offered it, and we always took it, but you don't from what I've only bought 3 houses, so from what I remember, it was always offered, would you like title insurance? Well, yeah. So, but that's why I didn't think it was a requirement. And when I Googled it, it said it wasn't. But if the banks are putting their foot down and saying you have to have it, well, then of course, the bank side is going to have it 100% of the time.
The bank side, its premium might be $1,000, and the homeowner's premium might be another $150 or something similar to that.
Right.
Right. Exactly. Yeah.
Okay. Any other comments before we move on? Great. Okay. Well, thanks for the good discussion on this. Let me see. So for the agenda, we'll move on to reviewing our current portfolio. Jack, would you happen to have the current holdings up and can present them?
Yeah, let me get them.
Okay. While you're pulling them up, I'll go ahead and start running through my
For
stuff.
your info, this is the
That's the tax lot.
cost basis lot. Yeah, cost basis list.
Yeah, that's what I want you to send me.
Right. Great.
Okay. For FleetCor, new value line came out. Second quarter earnings beat estimates with a 7.8% surprise. Revenues beat estimates by 5%. Last 4 quarters have all beat estimates. On a negative note, unfortunately, FTC accused FleetCor of, quote, fleecing small businesses, unquote, by charging hundreds of millions of dollars in mystery fees associated with fuel cards. The FTC reviews have determined that the promoted or promised savings in fuel costs that FleetCor kind of advertised never materialized for a big portion of their customers. Just for note, this isn't a new concern. The FTC tried the same thing back in 2019, charging them against a certain section number. I think it was section number 5 of the of a code, but the Supreme Court ruled that particular section that they filed was not applicable. So they've, I think, refiled against a different section, and hoping to get some more information on this. Price is still pretty high. It's in the hold range. It's $262 currently. Our buy is up to $233. And then Tractor Supply. One interesting note was that they've announced a multi-year agreement to be the official Life Out Here partner for the world's leading bull riding organization, which was interesting. I think colloquially known as PBR, I think Professional Bull Rider Association, PBR. Their broadcast desk on CBS will transform a set within the arena to a Tractor Supply branded open air broadcast booth featuring both brands and enabling fan engagement during the pre-show broadcast. So if you're a fan of bull riding, expect to see in the near future Tractor Supply branded items on the television broadcast for that. They also posted Q2 earnings, which beat estimates. Net sales increased 13%, earnings per share increased 10%. They repurchased approximately 1.1 million shares of its common stock for $203 million. They also opened 11 new Tractor Supply stores, one new PetSense store, and closed 4 other PetSense stores in Q2. They're cautiously optimistic for the near-term future, so they increased their forward-looking estimates slightly. And we're back approaching the stock high price that we saw in May of this year. So it's firmly in the hold, if not creeping into the consider buying zone. $193 per share. Our buy is up to 66. And then while I'm speaking in Sriram's absence, I'll go ahead and talk about his 2 companies as well. He sent some information on email before the meeting. For INS Intelligent Systems, they had their quarterly earnings call on August 5th. Q2 earnings increased to 66% from year over year. They project 20 to 25% revenue growth per year. They added a new Middle Eastern company, Al Ansari Exchange, last quarter, and a couple of more this quarter, expanding their business. A month or 2 ago, Sriram was concerned about the company's outlook, but now looks better. He has it in a hold range, so no action recommended. And SGC, Superior Group of Companies, had quarterly earnings call on July 28th. More normal, which is after spikes in PPE sales last year or early this year. Growth is picking up and continued steady growth projected. Projections by analysts continues to be positive. No action in the hold range also. It didn't include hold prices or buy range information, unfortunately, but both of those are holds. Okay, Steve?
Hi. So we'll start off with Visa. My SSG has them in the sell range. They're in the upper quartile of their 52-week high. They're more towards the 52-week high. Earnings came out for the quarter that was solid, $6.1 billion, and it beat consensus forecast by 4.7%. But the stock declined, so it sold on the news. Why? Delta variant. So people are being more cautious again, and so it literally sold on the news, even though they had a great quarter. I found this new little piece of information on Barron's because I subscribe, and 38 analysts, the average price target is 280. So I thought that was fantastic. Also, the Altman Z declined just a smidge to 7.37 for today. So it's solid, and I didn't really see any negative news on it. Alphabet is the SSG for Alphabet. I have that in the hold zone. It was blowout earnings for the quarter, $61.9 billion for the quarter. 4.6 billion of that was cloud. It's almost at its 52-week high of $2,800. Quite frankly, the only risk to this company is Congress. Of the Barron's 44 analysts surveyed, the target price on this company is $3,171. And the Altman Z went up to 13.89, over $1 trillion market cap, fortress balance sheet, enough said. DHI, which is DR Horton's, I have this as in my SSG as a buy up to $123. The Barron's analysts have the price target on this to $113. Phenomenal quarter. Income went up 77% to $1.1 billion for the quarter. The revenue for the quarter was $7.1 billion, up 35% for the quarter. Great quarter. The news is obvious. Home prices are raging. Home sales are raging. It's cranking. The interest rates are low. The environment is perfect for high home sales. It's about only $7 off its 52-week high, so it's at the upper reaches of it. And its Altman Z went up. It went up to 6.34. So compared to the last time it reported in June. So it's really strong. The only risk I see on this is when the interest rates start to creep up, this will get dinged. But that's what I've got. Thank you.
Okay, thanks. Ira?
Okay, starting with CBOE, their second quarter earnings per share was $1.38, which was up 6%. It beat the Zacks estimate of $1.35 by a little bit. Their revenue was $351 million, which beat the estimate as well. The revenue was up 18% year over year, and 11% of that was organic. I have it as a hold with a buy up to like 108, but the Investor Advisory Service has a buy up to 128, but it's at 127 now, so I would say it's really a hold. Regeneron, they announced the COVID treatment beat the sales estimates by $1 billion. It was at $3 billion in the second quarter. Their earnings per share was $25.80. Sales were $5.14 billion. Sales were up 22%, excluding, and that is excluding COVID numbers. Dupixent sales were exceeded expectations, and they were at $1 billion. I have it as a buy up to 630, but it says 625 right now, so it's really kind of marginal whether it's a buy or not. That's what I have.
Did you say they had a revenue surprise of $1 billion for the
sales,
COVID treatment?
Yeah, the sales of their COVID treatment, it says they beat the estimate of what the sales would be by $1 billion. The sales were $3 billion for that COVID treatment. I guess so. The estimate was $2 billion.
Wow, 50% beat. Okay. Thank you. Okay, Jack.
Okay, Dollar General is going to report the end of this month. They have their Altman Z is 3.7. They're doing fine. No other news that I could find. Thus, SFM, the farmers market company, announced earnings earlier this month. They beat earnings estimates and at 52 cents per share versus 5 cents last year. I think I got that right. Yeah. Then 30 cents in 2019. So their sales though is a little lower than it was last year, a little higher than 2019. So they're sort of coming down off their peak of sales and earnings from COVID panic buying. That's all I have for them. Their Altman Z is 3.2, by the way. Essent is up from last month. It's, as I said, almost broke. It's almost break even to where we bought it in January. They announced earnings on the 6th of this month. They had $1.42 a share, up from 15 cents. So that's 800% or something. And they beat estimates by 16 cents. So last year was when they did a write down of all kinds of stuff. The revenues are also up, but not very much. They actually did not meet estimates, the revenues. And they increased the dividend by a penny. And that's all I have for them. Oh, they don't have an Altman Z that I could find because they're a finance company, I guess. That's it for me.
Was either Dollar General or Sprouts, are they in the buy range?
Sprouts is in the buy range. Yeah, Sprouts is in the buy range, but just barely.
Okay, thank you. Okay, Liz?
Okay, so Middleby just had their earnings call this week. They had a really good second quarter. Net sales increased 71.4% over last year's second quarter. And they have a huge backlog of orders that like 90% over last year's backlog. So they have a lot of orders in the pipeline. The downside is supply chain difficulties in meeting those orders. Let's see. So overall, they're doing well. They were supposed to buy Well-Built. They missed that acquisition because an Italian company came in and offered more. So that's off the table. I mentioned that last month. They're a big growth strategy is mergers and acquisitions, so they're still continuing on that route with other mergers and acquisitions they're looking at. So I have them in the hold zone right now, and Value Line upped their timeliness rank the end of July, but downgraded the earnings predictability, upgraded the price growth persistence. So let's see here. So they are in the hold zone. FSFG, not a lot to report on them. I still have them in the buy zone, and my buy zone is quite a large spread, $29.50 to $97.10, and they closed yesterday at $80.43. So they're still in the buy zone. Value Line upgraded the technical rank to a 2, and the price persistence upgraded that to an 80. So that's FSFG. And then Alta. So Alta had a good quarter. They actually beat their estimates. Value Line has upped their fiscal 2021 earnings call to $12.20 a share, and they say that's a bottom line improvement of nearly 300% year over year. And the 2022 estimate increases to $13.90. So they've risen 80% over the last 12 months, and Value Line says they think that, that's going to continue. They'll be a good market performer in the year ahead. So their CEO is set to transition, but it looks like they've got that under control with a smooth transition to the new person. So so that's it for Alta. I have them in the hold zone right now. And that's it for me.
Okay. Great. Thank you, everyone. And with True Amount, I didn't look at anything on the watch list. Does anyone have any? Did they happen to do anything?
Yeah, I did.
Okay.
Gentex, Stride, and Nexstar are all holds, and I'm ahead. Algonquin on the watch list also. It's a hold.
Oh, did we? Okay, I'll add that to the agenda for next time.
Yeah.
Okay. So then I'll open up the floor to any motions for buy or sell.
You have a list of what we just said is in the buy range of our current holdings.
What I noted, and sorry, I might have missed the first company from Steve, but I have DR Horton is in the buy. Sprouts Farmers Market is in the buy, but just barely, it sounds like. And then FSFG in the buy.
Regeneron too.
Yeah, I thought he said that it was.
Yeah, I have a buy up to 630, but it's at 620.
Oh, that's right. You said it's not quite. It's almost. Regeneron question mark.
So I'll throw out an idea that Steve might have a connection with, but one approach might be that I very quickly, as we were going through this, pulled up the Essent SSG, and while I would agree that previous performance has been great, it looks like it's kind of flattening out, or at least it's nowhere near the growth rates that it has been. And then for the online SSG, when you put in the forecast, even the little pre-populated analyst 2-year estimate is 5% for the sales growth rate. So it doesn't look stellar just from that. And I had, as a just quick run through, I have it in the hold range, unfortunately. So I don't know. We've been with it for a little while. We've taken kind of the wash sale approach that we harvested losses. It's kind of back to zero. I don't know that this is really performing up to our standards. So I'll pitch that we sell Essent and we buy ITIC, and people can proceed to shoot holes on that as they see fit.
Yeah, I'm actually good with that.
That would be the only way I would have done it. Yep, I agree.
Yeah, I would go with that. Unless Steve has a compelling reason not to.
Yeah. Steve might be calming himself down before he stalks.
No, it's nothing like that. The projected on here from the analyst is 57. We're at 47. To Brent's point, I think we're going to tread water until the interest rates start to rise and the people that really want to buy a house are forced to use PMI. That's what it seems like. That the zero interest rate environment isn't good for them actually. But then when interest rates start to increase, it will. So I agree that's fine, because this will probably tread water for. Although I read the quarterly they just came out with earnings and they had the quarterly slides, and I drank the Kool-Aid, but in the analysis, it probably will tread water. I don't see it going higher than 57 in the next year. So.
And you're 57 being the stock price, you mean?
Yeah, exactly.
Yeah, okay.
Because it's 47, so you're only going to get 10 points out of this. It's not like it's going to double.
Right.
So, yeah. So you're right. It doesn't fit our profile where we're trying to hit the ball out of the park. So.
Okay. All right. Well, that sounds unanimous then. So we'll sell Essent, and then with that plus the cash, which is what, 1358, we'll put that into ITIC.
Okay, that would make, just see here. Yeah, that would make it 5 point something percent, 5.7%.
Yeah.
Yeah, that's all right.
So it's probably around the middle of the pack.
I'm just looking. Everybody's over 4% now.
Yeah.
Can I back up and ask an earlier question that I missed? One of our attendees asked, Stephen, when you were doing your updates, what was the first stock that you talked about? I missed the name, and she did also.
It was Visa.
Visa? Okay, thank you.
Yeah. Yeah.
Okay. Any other motions on buy or sell? Okay. And then Jack, I'll just swap in. We'll take off Essent and then swap in ITIC for the stocks you're tracking. Is that all right?
Yes.
Okay. Okay. Great. So we'll move on then back to the agenda. Old business. I just wanted to remind people about club renewal. Ball is in my court to update the form and get it sent in. I think we have another month or so. September is the due date, so still working on that.
So we got to write the check.
Yeah, we'll have to write the check,
Right.
and I'll get the information to you.
Okay.
And then for new business, just one item that I'll give it to you, Jack, regarding the online chapter annual meeting.
Yes. All right. Where am I? Sorry, I need to get back to. Oh, geez. Where is it? There we go. So if you go on to Better Investing and look for the online chapter, go to the online chapter page and look for Model Investment Club. I'm sorry, look for events. You'll get on this list. There's here, we have our October meeting today too. That's nice. But down a couple more, there's the online chapter annual meeting. All members is in August on the 26th, 7:30 to 8:10 Eastern time. But then there's a Cy Lynch was invited to speak at the online chapter, but there was some such interest that they switched him to Stock Up. So there's a Stock Up event right after the online chapter meeting. So if you click on this, you get the registration, and it explains here to go to the Stock Up OLC annual meeting to register for the education event. Is that clear as mud?
Yeah. So
Jack, can you do me a favor, please?
Yeah.
Can
Yes.
you please click through from the home page on how you got to this place, please?
Okay. Yeah. Let's do it again. All right. So you go to the online chapter. Where do you do it? This way.
Our
I
community.
always have
Our community.
Okay. All right. My chapter or other chapters if you're not in the online chapter. Now we're in the online chapter page, local events. So if you're not in the online chapter, you have to go to other chapters at that fork in the road. If you're not, yeah. So you go to other chapters and the online chapter would be here somewhere.
It's at the top, or the online is at the top.
Okay.
No.
There it is.
Well, there you go. And this all works even if you're not a member of Better Investing.
Yep.
Or supposed to anyway.
So you're all invited to the online chapter annual meeting and to Cy Lynch's presentation on his investing career, basically, I think is what he's going to talk about.
okay, thank you.
Yeah. Okay.
As a note, Joe, did you see that October meeting was set to the wrong date? Is that something that can be fixed?
I can fix that. That's not a problem.
Okay, thank you.
Thank you.
Okay, thanks, Jack. Let me take back presenter rights here, and I'll just highlight for upcoming meetings next month, September. Steve, I have you for stock to study and Sriram for educational segment, so I'll remind him over email. And if anyone has any problems with the pattern going forward, let me know. But because we haven't had any new members, this is just the kind of the pattern that I've been using and copying it forward. And then just as reference included in the agenda is the next couple of months meeting. Again, we're on the second Saturday of each month, 11 a.m. Eastern through a GoToWebinar. Okay, and with that, we'll close out the meeting. Thank you all for attending. Like I said, next meeting is same time, same place, September 11th on Saturday, 11 a.m. Eastern. You can find previous recordings of our monthly meetings, including this one, if you search for Yankee Model Investment Club on YouTube. If you're not already registered for future meetings, please do so. Go to betterinvesting.org through that same link that Jack just showed and register for our for the series of upcoming meetings. You can also search betterinvesting.org for a Visit a Club, which is a good program for investment clubs. And then again, if you have any questions or if you're interested in joining, feel free to reach out to our secretary, Sriram, at his email address there. He can point you in the right direction or answer any concerns that you have. Joe, are we okay with any other open questions or comments? We need to.
I think so.
Okay.
There's something just popped up. Stockbuck Reflections of a Lifetime Better Investor, and the registration that's outside of going through the thing is out there.
Yes. You have to register for both events.
Right.
Okay. Well, thank you all for attending. Hope to see you again next month, September 11th on Saturday. Until then, good luck with your studies, and we'll call it then. Thank you.
Thanks. Bye-bye.
Thanks,
Bye.
everybody.
Bye.
Bye-bye.
For anybody that wants that separate address, it's in chat.